what I am intending to do here is just kind of do an intro to options, and you will probably still have questions after it, but I know you want to be able to know which questions to ask, so you should definitely be there. So what I have open right here is just an option chain, and this is on Tastyworks. It's a little bit more simple. I'll show you what I have going on my other screen, but I'll show you this other screen in a little bit. This is actually how I look at the options, so it does look a little bit crazier, so we're going to end up there. But I guess we'll just go ahead and get started with, what an option is. At the we're all familiar with stocks. We all know what a stock is, and since y'all are index traders, most of you trading the index futures, you're familiar with what an index is and probably an ETF of an index, which is a fund that's based on the index that people can buy and hold like a stock. So on the S&P 500, that's generally the spiders or the SPY. And then on NASDAQ, that would be the QQQ, or they just call it the Qs a lot of the time. There's also SPX and NDX, but in general, most people focus on SPY and QQQ. So I'm going to focus on those, with the SPX and NDX are leveraged versions. And the NDX is really difficult to trade. I'll talk about that a little bit later. So since y'all are mostly futures traders and familiar with the ES and the NASDAQ, I'm going to focus on SPY. SPY is it's usually a little bit lower price options and slightly more liquid, so I do prefer it over the Qs, which is probably a part of how I became more of an S&P 500 trader. But so we'll start there. So what an option is if you have a stock, and it could be Apple or Amazon, Tesla, whatever, any of the banks, any of the airlines, any of the big stocks like that are likely to have options on it. And what an option is a contract to buy or sell the underlying stock or asset for a specific price. And that's what the strike price will be. So if you're looking at an option chain, this one we're first going to have to pick a date, so I'm just going to open up today's. This is the strike price. So that's the price that the contract is going to be valid at, basically. So do you want the right to buy 100 shares of the underlying at 677 or 689? That's basically what we're talking about. We're not looking at actually getting into the stock in most cases. There are some strategies where you're using options to buy as a way to buy something cheaper. But in general, when we're talking about trading options and day trading options especially, we're just speculating in these contracts. So instead of buying and selling Apple, we can buy and sell Apple options during the day. And the reason that we would do that is because they're leveraged. And this is oversimplifying, but it's a good way to start to think about it. So when you are looking at these strike prices, they have a bid and an ask like everything else. And so they have that going rate. But this is per one option, and what an option contract is, or the option to buy one at that price. But what an option contract controls is 100 options to buy. So you always multiply this by 100. So you've got the bid and the ask over here for these calls, and we'll catch up with what all that means in a little bit. But this is what the premium for each one of these strike prices is with the bid and the ask. And there is a little bit of a difference, and that, of course, is the spread, just like you have in futures. So there's going to be an equation if you were to buy SPY. So just like you can get an option on Apple or Microsoft that would be controlling those shares, you can get options on SPY, which are options on the underlying ETF, generally known as the spiders for short with a lot of the older traders. So that's what we're looking at here. So you have to, instead of, we're not even dealing in the underlying SPY or Apple or whatever it is. We're literally just speculating in these contracts that are either call contracts or put contracts. So on the call side, this is basically where we're looking to, in general, if you want the price to go up, you're going to be dealing with calls. And if you're expecting the price to go down, you're going to be in puts. So the way that you can get long or short the S&P 500 in options, of course, in futures, you're just hitting buy or sell. But with options, if you want to get long, you can buy calls. And if you want to get short, you can buy puts. You can sell calls if you want to be short, or you can sell puts if you want to be long. So there's also that side of it. But instead of talking about shorting them for, very basics, we're just going to be looking at buying calls to go long and buying puts to go short. And so it's a buy to open, sell to close, always. Unless you're shorting, but again, we're going to ignore that for the basics class. So unlike futures where you're buying to go long, selling to go short, you're always going to be buying to go long and selling to exit. And when you're dealing with options in this way, and y'all will enjoy this, this is buying and selling naked calls and puts. And what that means is you're just dealing with the contracts naked. There's no other complication to it, because when you hear people talk about option spreads, they might be buying and selling on both the calls and the put sides and making this combination contract, which of course is beyond the scope of this. But there are some more advanced things that you can do with that. But at the very basic, you just want to start with buying to open a call if you want to go long, or a put if you want to go short. So if the price moves higher, so on the SPY right now, so you can see the price on the spiders right now is around 684.10. So that's why on the option chain, we're between 683 and 684. So this is at the money. So when price, wherever the price for the underlying is, and we just looked up SPY, well, now it's at 684, but there's going to be something that's at the money at the money, in the money, and out of the money. So at the money is basically going to be the closest to where the actual underlying price is right now. Now it's back down to 683. So that's why we're right in this range here. So in the money are the ones that are, so if you're in an in the money call, you're going to be below the strike price. So that's why these are shaded here. And when we go, I'll show you my other platform in a little bit. It'll also be shaded differently. So this is showing you that, and you can see it right there, ITM, that's for in the money, and it's got a little caret pointing this way. So these calls are in the money because the price is over them. So just like these puts are in the money because price is below them. The people who are in a 690 put want the spiders to stay below 690. So you can see that the ones that are in the money are the ones that have the highest value, and the ones that are out of the money, meaning that the price is on the opposite, incorrect side of them, those are worth less. So this is where a lot of the speculation comes. When we're day trading options, a lot of the time we're dealing with these that are not quite in the money because we can get a really big premium pump as price moves and puts those in the money. You can kind of get an idea here. If these, 678s were, $1.60 down here, once they're in the money, this many steps, this many points, well, they're dollars now because we're not dealing in futures. But when we get in the money that much, that's the kind of potential it has to increase. It's a lot more complicated. You can't just do the math off of that, and we'll get into that in just a second. But the other thing I wanted to show, because I kind of skipped over this at the beginning, is we have all of these different dates. And this is the thing that really complicates options. And that is every single one of these contracts that we're dealing with, whether it's a call contract or a put contract, has an expiration date. And that's what you're seeing here. So I had pulled out today's. This is the 0 days till expiration contracts on the spiders, the SPY, because they expire today, December 10th. So these have 0 days left till expiry. Tomorrow's have 1, and Fridays have 2, and so on. So you'll see these also have weeklies here, and you'll hear this a lot. So the weeklies, and these were added recently in the past couple years where they started doing daily expirations for the spiders. So a lot of things won't have it. So if you're looking at Apple or Tesla, it's probably just going to have its weekly expiration on Friday. But one of the nice things that was added a couple years ago is the daily expirations on the spiders so that we can really trade these almost the same intraday on any day of the week. Because what'll happen, we'll look at the premiums for today, just kind of think in your mind, at the money is going for about $2. And if we go to Friday, so that's December 12th, at the money is going for closer to $4. So the closer it is to expiration, the cheaper it is. And that's because any of the contracts that expire today out of the money are going to end up completely worthless. So when you scroll down here, they've got the bid at 0 and the ask at 1 because that's the next thing you can go to. There's no other thing after that. So even if somebody bought these for $2 or $3 or $5, they're now worth 0. So that is the risk with options. When I'm buying these, that's my worst case scenario is 100% of this premium that I invest could go to 0. You can still do stop losses and bracket orders and all that kind of thing to mitigate your risk, but it's not as easy to get in and out of an option contract as it is to get in and out of a futures contract. So that's kind of worth noting. We do a lot of, limit orders I almost always use a limit order. The spiders and maybe the Qs is kind of the one thing you might be able to get away with some market orders. But what happens is, I don't know if I have a good example on here. I will when we switch over to the other option chain. Some of these are going to have some crazy spreads. This has a lot of liquidity and a lot of volume and a lot of trades. So it's going to trade most like the futures, which is why I'm using it as an example here. Yeah, Jared, covered calls are fun too, but that's another topic. You can get them into that one. Anyway, so that's kind of how that works. You never want to be at expiration out of the money, and that's why a lot of times we're buying and selling these pretty close. We'll kind of talk about what happens at expiration in a little bit. Let's see. So we got the expiration dates. Oh, I was going to tell you a little bit more about this though. So we have the weeklies. We talked about those. The reason they're called weeklies is they used to always expire on Friday, but for the spiders and some other things, they've added some intra-week closures. A lot of times there will just be one. This one that doesn't have a W on it is not a weekly contract. So there are also monthly contracts and quarterly contracts. So that's what you're seeing here. On this platform, and again, this is Tasty Trade. It is a good options platform. It also has really good graphics once you get into spreads and good analyzers. I don't trade with them currently, but I have played with them. I think they're good. But so these ones that aren't marked weekly, these are the monthlies. So these end up having a lot of volume and interest from a lot of the bigger funds and things, and they'll just be sitting in them. So you can tell that these numbers are a lot bigger than those other ones. They do have a lot of volume. And while we're on the topic of this, I mentioned this, but let's make sure this is understood. So when we're looking at these premiums, this is 12, this is 13. And like I mentioned, we're dealing with quantities of 100. So this is per option, and we're dealing in quantities of 100. So basically you can just move the decimal. So to get into one of these, it's not $12 a position, it's actually 1,200. So that's why you'll see a lot of traders with smaller accounts screwing around with these ones that are going to expire faster. That's why they get the reputation that they do. These are the degen options. They're also the most powerful. So if you think we're going to have a trend day, if you have a strong inclination that we're going to have a trend day, you can buy these options for cheap, watch the market explode, set a limit order up there, and take advantage of that. So that's what I'll do when I really am seeing a strong trend building. Maybe I want to play with it in futures, but y'all know it's really hard to hold some of these future things for a long time intraday. And so that's another way that we can trade it. It's also, you can swing this overnight. So I guess we can talk about the different account types a little bit here too. But with these option contracts, you can swing overnight and capture a gap up or gap down, and you will instantly kind of get this move that you're looking for. So when we are trading something really degenerate and high risk, like options, like earnings or anything like that, we're looking to get out instantly in the morning before the premiums are able to drop back down to normal. And we'll talk about why they do that some more in a little bit. Yeah, let's go earnings. But that's kind of what we're looking at on that front. And then the quarterlies also, when you've got these big funds that are moving their positions a lot more slowly, they can end up in the quarterlies also. When we talk about having the witching days and all that, it's when all of these contracts expire in the same day. So you've got everyone that's in these faster moving daily contracts, plus the people in the monthlies, and then sometimes those expire on the same day as a quarterly also. All right, where are we in my little list? We talked about in the money, out of the money. Oh, okay, let's talk about where options get that premium value that we were looking at. So, okay, so there's intrinsic value and extrinsic value, and the books and videos can go on with this for a really long time. If you want to dive into this really deeply, you can. And this is something that I kind of encourage you. Once you understand what you're asking for, then you can dive into this stuff more deeply. But a lot of it, you really just need to understand the basic concepts, which is intrinsic versus extrinsic. And you can even kind of think about, we have so many good examples. I'm trying to think of which one lately, but whenever anything's really hot and sells out quickly, that's where we start getting that extrinsic value. So I don't know what the hot toys are this year, but I'm always thinking about cars. So if you think about a car, it has some intrinsic value. The steel that it's made out of has some value. You could melt that down and make new things out of it. There's copper wires in there. You can melt that copper down. That value has that copper has an intrinsic value. Whatever materials you can salvage out of that. It gets extrinsic value when it's a really rare, cool car that is limited edition. Maybe there's only 1,000 of them made that year. There's only 50 made in this color. They're never going to make it again. Then it gets all that extrinsic value for being a limited edition Porsche or whatever. And that can change over time because buyers get kind of fickle. Maybe Ford trucks are the hot item right now, and those are really trending, and nobody cares about BMW, so that value's down. But then in 5 years, the import values go up, and those are cool because that's what the celebrities are driving on TV or whatever. And that's where you start getting some more of that just hype value. And the same thing happens with options. And there's a couple different ways that we can there's a lot of different ways that we can get it. But the two main ones that we need to pay attention to are the time and the implied volatility. So we kind of talked about the time when I was over here a little bit, because these monthlies are a lot more expensive. I even went out to January. We'll just look at December 19th. These are already looking a lot more expensive than those daily ones that we just looked at. And that's because they have more time to get to that price. So that's why, these swing trades end up being more expensive. I don't call some of these really expensive ones sometimes because they get kind of crazy. But what you're looking for is you're looking for these things to get to an extreme low on the higher time frame charts, and then do your speculating, because that's when you can get these crazy, 400, 500% moves when we get a big pump, even with some of these gap ups and gap downs overnight. It's also very speculative because it can all get sucked right back out. So that's why I'm really patient when I'm making the swing trades and things with this. So I also wanted to show you, oh, wait, I wasn't showing you that. Anyway, I was demoing on this. I'm always on the wrong chart or wrong screen, I swear. But I was showing how the December 19th options, these would be the monthly contracts, are so much more expensive than the ones expiring today. And that's because we have all of that extra time. But yeah, I mean, on the same note, so if we were going to speculate, we think that the S&P is pretty low right now. We think it can go up by the 19th pretty easily. You can see what kind of move we can get. So, I mean, from a 10-point move from, or it's not, remember, it's not going to always move exactly like this, but a 10-point move from 687 down to 677, that's a really big difference. Okay. And then I wanted to pull up my other broker. So just kind of keep in mind that this was showing vertically. This is Interactive Brokers Trader Workstation, and these dates are kind of across this way. So I really do like this platform. This is a much bigger screen, so it's a little bit harder to show you the details, but I need this bigger screen to show some of these different things too. So on this screen, I have the dates across the top, and sometimes I have to turn on the weeklies, quarterlies with this. It'll show you the regular, that's what they're calling the monthlies, and the the higher ones, and then these yellow ones are the daily expirations. So on this one, I can flip over to today, and it should be, well, that's tomorrow's. So what I wanted to show here is, like, we only had a few columns on that other screen, and that's basically this center section here. These were shaded gray on the other screen, and they're blue here, showing the calls that are in the money here and the puts that are in the money here. And then in the middle is at the money. The things that I added to this chart are some different information with the Greeks and things. So let me go back over. I'm going to switch screens. So let me double check I'm doing this right. Okay, so you may have heard about option Greeks, and those were kind of some of those extra columns. So we're going to go back to Trader Workstation in a minute. There's a bunch of Greeks, but these are the 5 main ones: delta, theta, gamma, vega, and rho. Delta is one of the most important. So I mentioned earlier that the premiums have all these different equations that go into the price, and there's the intrinsic value and there's the extrinsic value. So one of the extrinsic values is kind of, how much time you have left on there. And there's also that how much it's going to move in price. And those are the main ones that we're going to be paying attention to most of the time. So that's delta and theta. Delta is okay, this is how much, I'm just going to read it instead of trying to confuse myself here. This is the option price change measure for, well, it should be $1 underlying move. So if the SPY moves $1, this is the rate of change that is going to happen when that move happens. Theta is going to be time decay. So we just saw that the closer we get to expiration, that's the theta is how much we're going to lose the closer we get there. So that one's going to speed up when we get there. You'll hear a lot about gamma exposure. This is one that you could spend 20 hours learning about, so we're not going to go crazy about that one. But so it's officially the measure of the change in rate in delta. So, I mean, it is really important, but when they're talking about gamma exposure, they're talking about how exposed the hedge funds are to the rate of change when we have volatile moves in the market. So it's kind of good to understand what that is so you can explore. Well, that's another one. This is what Rocket Scooter Matt is dealing with a lot, is some gamma type stuff. Vega is the sensitivity of an option to the implied volatility. And we're about to go talk about that one. That happens a lot on the spiders. And then last, the rho indicates the sensitivity to interest rate changes. So you can see why that one's not as exciting for our purposes. At least in simple option trading anyway. So I have added some columns up here, and I have the delta and I have the theta. There are some option strategies built completely on how on the delta, because like a 10 delta is not very likely to go in the money. So the how much this is going to the rate of change for this is going to be slower than these ones that are up here, more likely to get in the money. I hope that's the best way of explaining that. So theta is going to show us how sensitive these are to time. So again, like the at the money is going to be the highest at this point, because going in and out of the money has such a dramatic effect on the option premium. And then the implied volatility is another one that I wanted to focus on here. So this should be kind of decently high today. Sometimes it's a lot higher on FOMC days though, to be honest. But the implied volatility, and let's see, if we go back to this chart, you can see that the extrinsic value is largely changed by the time and the implied volatility. So the implied volatility is going to be really high when we have a dramatic event coming. So if Tesla has earnings, this implied volatility is going to be higher than usual. If we have a big market event coming like FOMC, this is generally going to be higher than usual. Let's go look and see what it is on tomorrow's. So tomorrow's 20%. Fridays. Oh, let's doing that again. I'm not, there's morning expiration and evening expiration. I'm not going to dwell on this a lot, but make sure you're paying attention to that. I'll talk about that in just a second. But so yeah, these ones are down lower than 20, and then today's were all the way up near 40. Okay, yeah, I don't want to dwell on this, but this is actually really important. On the ETFs and the indexes, so like the SPX options too, there's morning expiration on some of them and afternoon expiration. Just in general, if you have that choice, just think evening expiration. That's when they settle. It's really the settlement, not the expiration. But when they settle, you want the one that settles at the time you're expecting. So the ones that settle in the afternoon are going to settle when the market closes in the afternoon. The ones that settle in the morning, you can't trade them when things close in the afternoon, but they settle at the price that we open at. So it's a little bit different. So a little bit more complicated, not 101 beginner stuff. So focus on the afternoon expirations when you get there. So this one, I was going to bring up Tesla to show you. And this is actually the platform that I use to trade options on. I went to an account that's not funded, so I don't do any accidental damage today. But I have good data here, so I wanted to show you some different kind of things that we can look at in the option chain. So this is the Tesla. These are the monthlies, December 19th right now. You can tell these are pretty expensive. Tesla does get pretty expensive. That's why I don't call these all the time. Again, sometimes we have to turn on the weeklies, monthlies. Sorry that's so small. This is on my huge screen. But the reason it's on this huge screen is I like to be able to compare all this stuff. So here's this Fridays. They're half the price of next week because, again, we don't have that time. They do have a little bit higher implied volatility on them. So that's just something you need to pay attention to. So here's the other side of this. If we have the implied volatility really elevated because we're coming into earnings or something like that, you have to remember that if that implied volatility is because of an event like earnings, once that event is gone, that implied volatility is gone. So when we're degenerate options gamblers on earnings, that's why it's a zero or hero move. Because you're paying an extra premium, extra extrinsic value here because of that implied volatility. And once that value is gone, you're just left with the intrinsic value. So if you have a big expectation that Tesla is going to run up to 600 with earnings because they're going to have these crazy earnings, and you go along, and then Elon comes on and he's like, actually, I don't really think that Tesla's any good, and I sold all the stuff. And the stock crashes, and you lose everything. You use 100% of that. So the reason that these out of the money ones are crazy expensive, everyone's like, oh, that looks so good. Because it's so unlikely for us to go there. Are we really going to go that high? And actually on Interactive Brokers, this shaded part here, these are standard deviations. So that's going to be more than a typical move to get anywhere into these lighter shaded areas. Yeah, so this is when the gamblers, I mean, obviously that's a massive move to pay off. These very, 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 very rarely pay off. When they do pay off, it's usually in something you had to wait a really long time for. So on that note, sometimes when I see an option idea And a lot of times I want to play with the big guys, right? I've said that a lot. I always want to be where the big players are. That's why I added open interest and volume columns. This is what I'm saying. Like, a lot of people don't have these extra columns. You don't need to have all of them. I have a big screen, so I'm able to have them on here. When I'm trading on just my laptop, I may not have delta and theta on there. I may just want to focus on the IV, the volume, and the open interest. But what this is this is going to be the volume for today for each one of these strike prices. So the 440 today has had 73,300 contracts traded. And there are currently 4,992 of those out there. Sometimes you'll see some crazy outliers out here, like 3,000 of these dudes. There's a bunch of bag holders on these 500 calls. They're just looking for a pop, trying to get out. That can be a little bit crazy. But what I'll do is kind of troll these farther out monthly contracts. Honestly, I'm going to stop using Tesla as an example here because it's too crazy. We'll just go into the spiders. So on the spiders, this is the 0DTEs. We'll go out to the monthlies because the monthlies is going to be where a lot of the hedge funds and things are focusing. That's where you can get an idea of where people are hanging out. So there's a lot of people hanging out in these 680s. There's a lot of people hanging out in these 685s. Not today. They're already there. They've already been in these positions. Sometimes you'll come to this and you'll see some massive volume that's like all of the open interest for the day. And those sorts of things really interest me. So we're just looking at the call side right now. You can also do the same thing on the put side. So this is the open interest, the contracts that are actually out there being held. And then this is the volume on them. So there are a lot of strategies that are based on the open interest and volume. And I definitely look at those also. I'm not seeing anything too exciting on these monthlies, but just as an example, which was I on? December? We'll go out to January. More expensive, of course. It gets a little thinner. And so it gets really easy to see where all these bets are being placed. And so when you're watching for like unusual whales and stuff, these are what their algorithms are picking up on. So you can even potentially kind of write your own or have ChatGPT help you with that or whatever, and kind of follow where all these big guys are hanging up. Look at this. Everything that's being held is like in 5-point increments. So you wonder why whole numbers and things matter. It's because that's where the institutions are hanging out. Okay, while we're on some farther dated contracts, I want to go back and talk about why I use limit orders a lot. So we've got the bid and the ask, which you're used to seeing on futures, but sometimes we end up with a bigger difference. So these ones that are at the money are going to be having more volume on them. So the spread's going to be a little bit tighter. So it's just a few dollars on these. And then the farther you go out, a lot of the times the spread can get a little bit crazier. SPY is not the best the best example for this one. What should I use for this one? I don't know. I'm trying to do something big and normal still, but not that's traded every single day. But so yeah, here's one. Look at the spread from 1570 up to 1620. So it's a $50 difference when you think about it, because we're multiplying this by 100. So you don't want to just mark it in. You're going to get a really bad fill, and then you're going to instantly be down, and that's no fun. So when I'm actually placing orders on options, and this is why I wanted to pull the screen up for you, I have a chart and I have a DOM, because then I can really clearly, I can't put one in because this isn't SIM. My SIM wasn't getting the data. I forget how to do that. But I can click on the DOM, buy or sell, but in this case, we're really talking about buy today. I can get my limit order really precisely placed in here. And then the same, once I'm in, then I can get my limit order to exit, or in this platform, I right click to do a stop order. I can get those in real quick just on this chart, or I mean on this DOM. And they'll also show up on my chart. And the reason that I wanted to, yeah, that's what I was thinking. Amazon used to have insane spreads. So I used to actually just play these spreads. I would just sit here with a limit order. They actually are really bad again, but I would just sit here with a limit order at 2040 and see if I would get in, and then instantly put another one just under this 2120 and hope for the best on when these things were not moving very quickly. There is a name for that. What is that? Arbitrage trading or something like that. That is a strategy. But before their splits, Amazon and Google, you could try to do that. If it was a really, really, really flat day, you could try that. Not recommended though. What was I looking at? Oh, I was going to show you the SPY and how this works really well. This is, you don't have to do this. I'm just showing you how I do it. I like to have the option chain in the chart and the DOM up. And the nice thing about the chart, so right now it's just a SPY chart because that's what I linked it to. But if I click on one of these, so if I click on, let's use one of these farther. I want something with a big spread on it anyway, so you can see it. But well, this is a terrible example actually, because that's like where the one sale was. Let's go into an easier one. We'll go into the 685s for today. It thinks I want to buy it. It's bringing up an order window. Okay, so this is the chart for the actual 685 that expires today. So you can have a chart for the SPY, and you can have a chart for the actual individual contract. So this is the SPY December 10th 685 call. So when you're talking about options, you have the underlying, you have the date, and you have the strike, and then of course whether it's a call or a put. So this is the chart for that individual contract. And it's going to be a little bit different than the SPY, but I like having this up here because then I can see really clearly where a limit order is more likely to get taken, because if I'm going to put one down here, that would be a new low. Do I want to be betting that I'm going to get in at a new low? I don't know. So that's why I like having the chart there. But as far as placing limit orders, the DOM is really, really nice on a lot of platforms just to make sure you get there. So sometimes, I mean, most of the time I'm scaling in, so I might have a buy. I'm not trading this. I haven't looked at the charts. I'm just literally talking out my ass right now. Okay, but I could put an order in at 115 and 110 and 105 and just scale in that way. And then I can do the same thing on the way out. I can scale out. I want to put one at 140. I'll put one at 145. And then that helps me keep taking profit with these strong limit orders and making sure that I take full advantage of some of these swings like that. Okay, I was just seeing if I missed anything in the chats. All right, we're actually doing really well on time. So if you have any questions, you can start thinking of them. I'm going to go kind of over what happens at expiration. And some of this can happen before expiration. So there's two ways to get out of an option. You can get out of it at expiration, or you can get assigned. So this doesn't happen a ton when you're dealing with these index options, but basically, so the contract has the expiration date. We're looking at these ones for today that expire today, December 10th. So at the end of the day, if it is below the closing price, it's going to be worth nothing. So if you're still holding that at the end of the day, the value is nothing. Most options you have to sell to close. And I know this sounds weird, but some of them you don't. But SPY, Tesla, Apple, those are, it's called American style settlement. So you have to close out of it. There are some that have European style settlement, and that would be something like SPX. And we'll go look at that for a second. So the spiders is the main S&P 500 ETF. And then you get into different leveraged ETFs. So the 10-time leverage is the SPX. So this is going to follow the futures a little bit closer. There's going to be a gap between the futures price and the XPX price, but that's because the futures price it's the S&P 500 futures, so it's supposed to be the SPX price at the expiration date of the contract. So right now our December contracts are expiring on the 15th. So ideally, the future contract is telling us what the value of the SPX should be on the 15th. So it'll start out with a massive spread, and then it gets tighter. They've been really wide lately in general, but that's kind of where these numbers come from. But anyway, where was I going with that? So SPX is a European style settlement. So this is the reason that I like using these for spreads a lot too, is when you, if you're in an SPX option and it's worth something at settlement, then it's just going to settle for cash. You don't have to necessarily exit it. So I can be a little bit lazier. Not all brokers do that. So I was showing you 𝗕𝗲𝘁 earlier. 𝗕𝗲𝘁 will automatically close it for you. Interactive brokers will let you settle it, settle to close. It saves you the commission, and it can also potentially save you the day trade. So I said we're going to get back to account types. There's two main account types for trading options. You can have a cash account or a margin account, and I have both, and I'll tell you what the advantages are. I started out trading a cash account, and the advantage to a cash account is you are exempt from the pattern day trader rule that the SEC has, that futures is also exempt from. But unlike futures, so futures is just flat out exempt. The cash account, you're once you use that cash for the day, it's like a bank. You have to wait for close to get that money to settle and be used again. It's like having a pending charge on your credit card. Once you've used that cash is just pending, and you don't have access to it until everything settles. So it's the same way, the way the cash account works. If you've got $1,000 in there and you go into a $500 position on the spiders, and then you close it, even if you have $1,100 now, you still really only have $500 that you can trade with for that day until all of the cash settles. So the way to work around that is by getting a margin account. The margin account lets you reuse that cash all day as much as possible. You don't have to wait for it to settle because you're using your margin privileges, basically. But that's subject to the pattern day trade rules. So that currently, if you have less than $25,000 of account value, net liquidating value, you can only place 3 round-trip trades in a 5-day period. The problem is, a lot of times when you're scaling in and scaling out, that ends up counting as multiple trades. So one trade can end up restricting your account. And when they get restricted, it's done for 90 days. So that really sucks. Which is why when people are starting out with small accounts, they've been using cash accounts. That's only for opening and closing in the same day, though. So if you want to swing trade it and hold it overnight, that doesn't count. If your broker lets you expire it, expire it, that doesn't count. It's a little bit riskier, though, because you might have to close out and not have it be in value at the end of the day. What's up, Adil? Okay, so FINRA, and this is the stuff, I made a video about this a while ago, but there's a lot of other people talking about it too. The FINRA case that's going on right now is working on lowering that limit from $25,000 all the way down to $2,000. So that means you would only need to have a net liquidation value of $2,000 in order to day trade, making multiple round trips in your account on options. That would be awesome. I'm sure there's going to be other limitations and things, and I would expect the brokers to want to apply some themselves also. But if that's coming, that should be coming soon, like hopefully 2026. The cash accounts are great because you can avoid all of that. You cannot trade spreads on a cash account. So that's why I had both. When I was able to, I started out with a tiny account, but when I was able to split up my funds, then I was trading some of them in a margin so I could do swing trades, and some of them in a cash account so I could do day trades, until I got it up to $25,000, $30,000 range, and then I put it all in one account. A lot of brokers will let you have both, so I was able to move money back and forth between the two, which is also kind of handy too. You can kind of skirt the system a little bit on that. BMO wants to tell us his real thoughts on FINRA. But yeah, we are dealing with that. So does anybody have any questions? Like, I'm hoping that at this point, even if you have to digest all of this, now you kind of know what we're starting with. And then we can kind of go from there. So, I mean, like earlier this week, what did I do yesterday? Was it yesterday or the day before? I was doing some, I did a scalp on Apple options. So what I did is I just went all the way out to this Friday. So Apple's a good example. You can see we've got the weekly and the monthlies on that one. But in general, we've got a contract that expires on Friday. So I just literally, I don't remember what it was. It actually was a put. So I would be on the put side. So these puts that are below the price are out of the money. So those are the ones that I am usually kind of looking at speculating on. So this is buy, this is sell. When we're first starting out, we're just trying to buy and sell them. We're not trying to short them and do spreads or anything crazy. So here would be the contract for that one. So that would be a thing where I'm just trying to put a quick little buy order in down here and then quick wait for a pump, because that's the way these premiums work a lot. We're just waiting for a pump and then can get out of that real quick. So in this case, on a put, I'm hoping that the Apple price goes down so that this put increases in value as it becomes in the money. I'll kind of wait a little bit, see if we have any questions. I started out on Thinkorswim. A lot of people like it. I don't. I did end up, I like interactive brokers a lot because they're so powerful. So I've moved some trust accounts over here, and I have an IRA here now too, interactive. And so I can switch between all the different accounts and manage them all kind of on one screen. So I also like Tastytrade. For me, interactive brokers makes more sense. They have better API and things too. So I have some bots that I can run on interactive brokers. And I wasn't really able to do that in Tastyworks, but Tasty has, it's a much prettier platform. Let me go back over to that one. Yeah, I think their commissions are a little bit more too, but what you're paying for is like, you can, and this is more useful when you get into spreads, but you can do all these really full analysis on how likely these things are to make you money. And you can get a really good visualization. So we look at this in my spreads class a lot because it's, I don't know, it's a nice way to look at it. Oh, now the kitty cats are in here. Uh-oh. I don't even know how I got out of here now, but okay. Yeah, you can negotiate your fees. I was going to bring that up too. So I don't remember how exactly it worked at Thinkorswim, but it might be different anyway now that they're not with Schwab, that they're on, I mean, you know what I'm trying to say? No, they are with Schwab. But so I did do that on Thinkorswim. If you're spending a lot of money, and usually you have to go ahead and be trading options a little bit to show them, but if you're doing a lot of volume, they usually will reduce it. I was wondering, I didn't want to say that. So I have a reduced rate at Interactive Brokers. I am an accredited investor though. So if you don't know what that is, you're not. But there are kind of some different plans that you can get on with different brokers. So where do we start at a broker? So this Tasty account that I'm showing you right now, this isn't even funded. I just have it so I can use their tools and stuff. This is on a browser. So if we're going to compare brokers between Tasty and Interactive, I would say Interactive Brokers or Trader Workstation is their platform is more NinjaTrader, and Tasty is more Trade-of-8, because you can do it on the web. You can have a little platform, and I just have the option chain on here, but they do have charts and everything. Where even is chart? I don't know. This isn't the way I usually have it set up, so I'm a little bit lost. Yeah, the Tasty desktop was crashing on me earlier. This is the web version. The desktop, I usually am using the desktop. It's just, it cursed me because I wanted to show it to you guys today, so it won't stay open. The Tastytrade desktop. Yeah, that's why I'm recommending it to you guys. A lot of people that I respect are on Tasty. Interestingly, the guys who started Tastytrade came over from TD Ameritrade on the Thinkorswim platform side. But you can, I mean, you can paper trade these just like you can paper trade anything else. I don't know how to paper trade on the Thinkorswim. I mean, on the Tasty Trade platform. Thinkorswim though too, if you want to download Thinkorswim, definitely has, that's one of the easier ones to do market playback and paper trade some previous things. And I don't think you have to have an account funded there either to do that. Interactive Brokers has playback. It's a little bit more complicated. So if you're trying to sim trade, I still go sim trade in Thinkorswim, even though I hate running it because it crashes my computer. I still paper trade in Thinkorswim a lot. Yeah, that's a good point. So if you're on a Mac, Thinkorswim is crap. And everyone will tell you there's these fixes that you can do, because if you Google, there's fixes that you can do. And it will speed it up a little bit. The problem is every single time you're running a chart, it's so much data to process that it's going to slow your computer down exponentially. And it's actually because of the software language that it's written in. This is the easiest way I can explain it. So if anyone ever wants to correct you on this, you guys are going to know now. But there are software languages that are written for an Apple Macintosh operating system. And there are software languages that are developed for Windows, and they're not always compatible. Some of them are, some of them aren't. JavaScript, which is what Thinkorswim is written on, is not. JavaScript needs to be run on basically an Intel style processor, which is why it works better on the older Macs. Now they're on an Apple Silicon processor, and that processor is not meant to translate, or it's not meant to read JavaScript. So it has to use a translator. So every single tick you have on your chart that it's trying to display and process all of this information, instead of just processing it, it's getting the information, it's translating it, and then it's processing it. And so there's absolutely no way that Thinkorswim will ever operate as intended on a Mac with an Apple Silicon chip. Doesn't matter if you fix it or hack it or whatever, that is what the problem is. So. All right, y'all. Well, thanks for joining me. If you guys want more options content, we're going to do more options content. I think it's going to get bigger over the next couple years, and I wanted to get y'all in before it gets crazy. My idea is to put $500 in a cash account and start sharing some challenges. I'm not very organized right now. I'm going to tell y'all, I'm losing my mind over Christmas. So I think it's not likely I'm going to start this in December, but that gives you a little chance if you want to kind of try to come up with some money to start a little options trading account. I'm going to try to do that probably at the first of the year when I can focus, because I'm going to be traveling at the end of the month too. So not a great time to start things. Thanks for joining, and I'll be in chat for the FOMC stuff. I'm not going to trade it. I just want to, I like to watch sometimes. It's fun. Of course you are, Andy. All right, I gotta find the clothes. I'll see y'all soon.